While double bottoms are a technical charting staple, there's a highly specific, rarer variation that most traders overlook entirely, the Eve and Adam double bottom. By the end of this video, you will know exactly how to spot this pattern, calculate precise price targets, and avoid a specific trap that ruins 64% of early entries. The absolute first requirement for this setup is context. This pattern is only valid if it forms at the tail end of a clear multi-month downward price trend. Mastering the exact rules of this specific variation gives you a mathematical edge over traders who rely purely on gut feelings to trade messy, standard double bottoms. To identify the Eve and Adam double bottom, look closely at the two valleys. They cannot look identical. The left bottom, Eve, needs to be wide and rounded with short, bunched price spikes. The right bottom, Adam, is starkly different, narrow and V-shaped, defined by a sharp downward price plunge lasting 1 or 2 days. On this chart, notice the contrast, a wide, rounded basin followed by a sharp, violent V-shape. Check the horizontal alignment. The lowest prices of these two bottoms must sit within 4% of each other, separated by 2 to 7 weeks. There is also a vertical rule. The highest peak between the two bottoms must rise at least 10% higher than the lowest valley. Strictly enforcing these specific shape and proportion rules is your first line of defense against bad trades and false signals. Now that you have identified the pattern, you need the most critical tool for executing the trade safely, the confirmation line. Find the highest peak between the Eve and Adam bottoms and draw a horizontal line across it. Here is the beginner trap. Buying while the price is still forming the Adam bottom below this line means the pattern fails 64% of the time. There is only one valid entry trigger. You must wait for a daily candle to decisively close above the confirmation line. That is your breakout. If the price drifts entirely below the Adam bottom before breaking out above the confirmation line, the pattern is dead. Cancel your alert and walk away. Patience serves as your ultimate risk management tool. An unconfirmed pattern is nothing more than a downtrend continuing to lose you money. Once you enter the trade, you need a mathematical strategy to determine exactly where to take profits. This is called the measure rule. On this chart, we start by calculating the total height of the pattern. Subtract the lowest bottom price from the confirmation line price. Next, take that calculated height and project it straight upward, adding it directly to the confirmation line. For example, if your confirmation line sits at $12.50 and your lowest bottom is exactly $9, your pattern height is $3.50. Add that $3.50 to the $12.50 breakout, and your precise target is $16. Calculating this exact target in advance removes human emotion and greed from your exit strategy, giving you a clear plan before you ever risk capital. To maximize your win rate, you can look for optional statistical boosters, traits that historical data proves will increase the pattern's success rate. First, pay attention to the broader market context. This is a bullish reversal pattern, and it yields substantially higher average returns during an overall bull market. Second, analyze the bottom depths. The pattern performs better if the left Eve bottom sits slightly lower in price than the right Adam bottom. Finally, look for a generally falling volume trend throughout the formation, and prefer breakouts that cross the confirmation line smoothly, without a sudden leap or gap in the price. Stacking these statistical boosters on top of a perfectly shaped pattern shifts the mathematical probabilities heavily in your favor. Let's review the core system. Start by spotting the specific shapes, the wide rounded Eve, followed by the sharp V-shaped Adam. Remember the critical safety mechanism. Never execute a buy order until the daily candle decisively closes above the confirmation line. Open your charting software, scan for multi-month downtrends, and practice identifying and measuring this exact setup on historical data. Applying disciplined, rule-based pattern recognition is the exact line that separates gambling from professional, systematic trading.